Okay, so this is Bev, which is question 14 in section B from the 2023 paper 2, the management accounting paper. So let's just have a little look through here. Bearing in mind what we're being asked to do, we're being asked to prepare a budgeted income statement for the year ended 31st of December 2024 for Bev, worth 6 marks. Okay, so it's telling us here that Bev plans to start trading as a sole trader on the 1st of January 2024. So remember, this would have been set in June 23, so this would have been in advance. She's going to be a wholesaler of ceramic plant pots. She needs to prepare budgeted financial statements and has provided the following estimated financial information. So we've got a whole list of things. As I said, we've got to do a budgeted income statement in 14.1, but 14.2, we've also got to prepare a budgeted statement of financial position using the bank balance as the balancing figure. So we need to slot everything else in. So let's just have a little look through then and see what's what. So revenue for the year is expected to be £60,000. Okay, so that's going to be your sales figure. All sales will be made on credit, and trade receivables are expected to pay their accounts 1 month after the sale is made. So that means that at the end of the year, we're going to be owed 1 month's worth of sales, which is going to be £5,000. So let's just pop trade receivables in there while we do it. It's going to be £5,000. So that's 1/12. Purchases for the year are expected to be 24,000. That's £2,000 a month. All purchases will be made on credit, and trade payables are expected to be paid 1 month after the purchase is made. So trade payables then is going to be 1/12 of that figure. 24,000 divided by 12 is going to be £2,000. So again, that's 1/12. So what we'll be doing is including the full amount of sales and the full amount of purchases, but in terms of the cash flow, we won't have received £5,000 when it gets to the end of the year. We'll still be owed a month's worth of sales, and we won't have paid a month's worth of trade payables. Okay, it tells us that revenue and purchases are expected to occur equally across the year. So that just tells us that the sales are going to be 5,000 a month, purchases 2,000 a month. Closing inventory is expected to have a value of 3,800. Now, just a little reminder here, there's no opening inventory because it's a brand new business. Rent for the warehouse is expected to be £1,300 a month. So we need to make sure we multiply that by 12. So 1,300 a month is 15,600 in rent, and it's going to be paid 1 month in arrears. So we're going to need to accrue. There'll be an accrual for 1 month's worth, so 15,600. I don't need to divide it; it's given it there. So £1,300 will still be owing at the end of the year. So that's going to be in other payables on the statement of financial position. Okay, other costs per year are expected to be admin and marketing 2,400 and wages 18,700. So both of those are going to go on the income statement, and there's no accruals and prepayments to deal with there. Okay, it tells us that Bev will purchase a delivery van for £12,000. That's a non-current asset. She's going to depreciate the van on a reducing balance basis at 30% per year. Okay, so 30% of £12,000 is 3,600. I'm going to write in the margin, which is very naughty here. So that's the depreciation on the motor vehicle. She's also going to purchase some equipment for the warehouse for 9,800. She will depreciate the equipment on a straight line basis for 4 years. The equipment is expected to have a scrap value of 1,800. 4 years depreciation charged in the year of purchase of all assets, and it doesn't matter about disposals because we haven't got rid of any. But if we work out the depreciation on that equipment, 9,800 is the cost, 1,800 is the estimated residual value. So she's losing a total of £8,000 over 4 years, which is going to be £2,000 per annum also for depreciation. So we'll put those in the income statement, 2 separate figures. Bev's going to invest £7,200 capital from her own savings. So that's going to be capital introduced. And then she's going to make drawings of £1,600 across the year. So that's not per month, that's for the whole year. So not very generous on the drawings. A 6% bank loan for £15,000 over 5 years will be taken out on the 1st of January 2024. Monthly repayments will be made across the period of the loan. Interest will be charged on the balance outstanding at the start of the year. So remember, this is the first day of the trading period. So 1st of January, she's going to owe the whole amount, £15,000. So the interest is going to be £15,000 times 6%. because that's what she was outstanding at the start of the year. So that's £900 in interest. And then she's going to owe, she'll have paid off 1 year's worth. So she's got 4 years worth still owing. So if we divide it by 5, so £3,000, she's going to owe, she'll pay £3,000 a year back. So if we divide, so 15,000 divided by 5 is £3,000 in repayments per annum. So that means at the end of the year, she'll only owe £12,000 because she'll have repaid a year's worth. So on the statement of financial position, as a current liability, it's going to be 1 year's worth, £3,000. And as a non-current liability, she's going to owe £9,000. So a total of £12,000 will be owing because she'll have paid £3,000 off during the year. And then it tells us that the bank has agreed an overdraft facility of £5,000. Well, that's not going to impact our figures, but we'll be able to see what Bev's overdraft is when we do the statement of financial position. Okay, so let's make a start with the income statement then. So remember, it's the budgeted income statement. Let's give it a title. Budgeted income statement for Bev. And it's for the year ending 31st of December 2024. Give it a couple of columns. So if you remember, the sales were given to us right at the start in note 1. It's going to be £60,000 there. Cost of sales, just a reminder here about layouts. You really do need to learn the layouts for these financial statements, otherwise you really are going to be stuck. Remember, there's no opening inventory, so we can pile straight in with purchases, which we're going to be £24,000. There's no carriage inwards, there's no returns outwards or anything like that to worry about. So then we can just take off the closing inventory, which is going to be, closing inventory was here somewhere, wasn't it? Closing inventory is expected to be £3,800, so that will reduce the cost of sales. So that's going to give us £20,200. Take that away. That will give us the gross profit. Make sure that things are labelled up properly. So our gross profit for Bev is going to be £39,800. Okay, so all we need to do now is just work out the expenses. So we say less expenses. And apologies for the scrappy nature. I'm just trying to keep this as quick as possible. You don't want to spend time sitting here watching me write things out slowly. So what do we have in the way of expenses? So she's got rent, £1,300 a month, remember. So £15,600 payable in rent. She's got admin and marketing, which is £2,400. She's got wages of £18,700, and then she's got depreciation on the motor vehicle, which is £3,600, and on the equipment, which was £2,000. And I think that was it. So remember not to, oh no, we've got loan interest of £900. Make sure we don't include any alien items, so things like drawings or anything that's to do with non-current assets and so on should not be included in the income statement. Save those for the statement of financial position. So expenses then, a total of £43,200. And if we take one away from the other, it will give us her profit for the year, budgeted profit for the year, £39,800. And actually, it's a loss. So let's change that to loss for the year. Make sure it's labelled up properly and put it in brackets because it is a loss. Okay, so that's the first part done. I'm going to do the statement of financial position. So I'm going to squash in because there's not that much space actually here. Budgeted statement of financial position. For Bev, this is going to be at the 31st of December 2024. So we're going to have 3 columns at the top here for the non-current assets. We're going to have cost, depreciation, and net book value. So the first figure we need is non-current assets. And we've got 2. Remember, we had a motor vehicle. And the original cost of the delivery van was £12,000. and we've depreciated it by 3,600. So the net book value will be 8,400. And we've got some equipment that cost 9,800. And we can ignore the residual value for this bit. £2,000 of depreciation leaves a net book value of 7,800. So if we add those two net book values up together, 8,400 plus 7,800 is 16,200. Then we can move on to our current assets. Okay, now, if you remember, we do these in the order of least liquidity. So we start with inventory, and then we have trade receivables, and then we have prepayments and bank and cash. Now, I'm going to take a bit of an educated guess here. There are no prepayments. Remember, we only had just one accrual, and that was for the rent that was going to be paid in arrears. Looking at this, the fact that she's made a loss, she's not really put that much money in, she's got an overdraft facility agreed. I'm going to make the assumption here that she's going to end up overdrawn, but we could just leave a line there blank just in case. So we could have bank, I'll put question mark there. We know we've got closing inventory, which is expected to be 3,800. And we know we've got trade receivables. Remember, that was 1 month's worth, £5,000. Okay, so at the moment, our net current assets add up to £8,800. Current liabilities, we have got the trade payables, which were £2,000, 1 month's worth of purchases in there. We've got the accrual, or other payable, which is £1,300 for the rent, so we can pop that in there. We've got a bank loan. Remember, we've got 1 year's worth. It's going to be a current liability, so we need to put that £3,000 in there. And we're probably going to have a bank overdraft as well. Okay, and I'm not going to add that up at the moment because I think we are going to need the bank overdraft, but net current assets going to be the difference between current assets and the current liabilities. Apologies if you're used to doing this in the International Accounting Standards layout. I'm very much old school. I much prefer this one. With the IAS version, you don't get that net current assets figure, which I think is quite useful. And in my opinion, you also overstate the value of the business, showing assets being equal to liabilities plus capital, I think is a bit peculiar, but don't get me started on that. So net current assets is going to be the difference between these two when we've worked them out. And then current assets, either plus net current assets, or it could be net current liabilities, which we might need to take off, is going to give us a subtotal. We're then going to need to take off non-current liabilities. Now, because I'm running out of space, I'm going to squash that onto one line. Non-current liabilities is the rest of the bank loan. So this one up here is just 1 year. We've got another 3 years still outstanding. Remember, it was 5 years in total. We've repaid 1 year. 1 year's gone into current liabilities. The other 3 years, so £9,000, is going to be coming off there. And then that's going to give us our net assets figure. Okay, then of course we're going to need to work out the capital account. So the key to solving this one, it's a little bit incomplete recordsy really. The capital account is going to start, a line under there, with capital introduced. So Bev was planning to put in, I think it was £7,200 from her own money. So she's going to invest that in the business. She's made a loss for the year. The loss for the year, I think, was £3,400. Just work that out. And then she's going to take drawings, which are only going to amount to £1,600 across the year. Okay, so the net worth of the business, 7,200 minus 3,400 minus 1,600 is only going to be £2,200. Okay, so because assets minus liabilities equals capital, we can substitute that figure in there, £2,200, and then start working backwards. So 2,200, reverse the sign, plus the 9,000 means that this figure here needs to be 11,200. Okay, now if we've got 16,200 up here in non-current assets and we want 11,200, then this must actually be a net liabilities figure, net current liabilities of £5,000. 16,200 minus 5,000 is 11,200. So that means that our liabilities, our current liabilities, are £5,000 more than our current assets. So if we add £5,000 onto that, that tells us that the current assets needs to be 13,800. Now, 13,800 minus the 2,000 we've got for trade payables, minus the 1,300 for the accrual, and minus 3,000 for the bank loan means that we've actually got an overdraft of 7,500. So we don't need that bank line there, but the balancing figure, I'll just put in there, BAL fig, is £7,500. As I said, we could have worked that out. We've got enough information to be able to do it, but it takes quite a long time. So far easier just to stick that in as a balancing figure. So now the statement of financial position adds up, and we're good to go with part 3 of this question, the 6 marker. Okay, so the 6 marker then for this one, it says Bev has experience in a wholesale environment, but she does not have financial experience. She knows that the UK ceramic pot industry can be quite unpredictable because clay suppliers are mostly based in Europe. And what we've got to do is assess the usefulness of preparing a budgeted statement of financial position for Bev. So to assess the usefulness, we need to say why it would be useful, and then perhaps give some reasons why it's not so useful, and then perhaps overall assess whether we think that it will be useful for Bev. So this is a budgeted statement of financial position, not so much the income statement, but the financial statement of financial position. So if we actually have a look at what's gone on, because we're going to get extra marks if we can relate our answer to the figures we've just produced, this is telling us some fairly interesting things. It's telling us that actually her bank overdraft, so I will be flagging this up, the limit that she's arranged is £5,000. So this is really quite useful. She's done a predicted statement of financial position here, or we've done it for her, and it's showing that her overdraft is going to be £2,500 higher than the overdraft limit she's agreed. So that's going to enable her to take some action about that. So she can either go to the bank and ask them to increase the limit, or maybe she could revise some of her forecasts. Perhaps she could, lease the equipment instead of buying it. Maybe she could not give her trade receivables any credit. Maybe she could hold less inventory. There are certain things she can do to improve the cash flow. I mean, taking less drawings is probably not going to help. Maybe she could increase the amount of the bank loan so that she covers the full cost of the non-current assets. That would help her cash flow situation. So it is going to be really useful for that. It's not so useful in terms of the fact that it's all an estimate. So it's very much dependent upon her forecast for her income statement being correct because of the knock-on effect on things like the value of assets and her cash flows. It's saying that go back to the question, that the industry can be quite unpredictable because clay suppliers are mostly based in Europe. So that would suggest that perhaps prices of raw materials or the imports, the clay pots that she's buying in could be quite volatile. So it would be quite hard to forecast, what her purchase costs will be. And that would have a knock-on effect on her inventory. But overall, I think it's a useful starting point for Bev to have those discussions. The other thing that is on the statement of financial position, although we're not really talking about the income statement here, it does show us that she's made a loss for the year. So she might decide that actually it's not worthwhile even starting this business. So the fact that she's doing this in advance could help her to make those kind of decisions. But remember, as always, we're trying to get up a marking grid here. We're trying to make sure that our answers are fully supported by a wide range of evidence. That means bringing your extra knowledge in rather than just sticking to the source data that's given. A clear and balanced analysis of the data, information, the issues is provided, showing a logical chain of reasoning. And it's given us some ideas here, things that we might include. So reasons for preparing the budgeted statement of financial position. It will give her a comparison for actual results and can identify areas of improvement in future years. It's going to focus Bev on the real costs involved, and she can make adjustments prior to the business starting. This is helpful because she doesn't have financial experience. She might not be aware of all the costs. As we already mentioned, it shows a loss, so she might decide that the venture isn't worthwhile. It's also showing an overdraft that's in excess of the one that's been arranged. That will give her the opportunity to reassess her financing, maybe rearrange a larger overdraft. And it can also provide supporting evidence to the bank of the viability of the business. And the bank may well ask to see that if she's, applying for a loan. Reasons against it: she doesn't have financial experience, so her forecast may be wrong. So it might not be a realistic budget, could lead to poor decision making. If the industry is volatile due to exchange rate, it might mean that the actual results are so far away from the budget, it's not useful for comparison, and other documents that might be equally useful, such as a cash flow forecast or a break-even analysis. And Bev might be better off using her time to prepare those. So there's no way they'd expect you to put all of that into the answer, but hopefully that gives you a few ideas. Thanks very much for watching.